lot of these agents will go have 4 gin and tonics and go to the vendor booth and go pull out their credit card and start buying stuff, right? You see it. I've been there. I've been there.
Stop it.
Been there.
You get out. You stop it right now. That's never happened.
Those listening right now are like, oh, I did do that. I did that last time.
You talk about it privately. We talk about it publicly. This is the Real Estate Insiders Unfiltered podcast. Welcome again to the Real Estate Insiders Unfiltered podcast. I'm your host, James Dwiggins, along with Mr. Keith Robinson, aka Crazy Uncle Robinson. I'm going to change the name again.
Oh, gosh. Yes, sir.
Tell us about John Campbell, the managing director at Stephens, which is a big Wall Street firm. So everybody has a little bit of perspective, covers our industry. Take it away, Mr. Robinson.
Yeah, he came in, he talked about macroeconomic trends, interest rates, the U.S. consumer. And then more importantly, this is going to be a recurring theme. We'll do this every quarter. We go company by company in residential real estate, and we'll unpack their earnings reports and what this means for share price, for the industry. So really thoughtful guy, deep ties into Wall Street.
Super smart.
Yeah, super smart. Focuses on our industry exclusively. So it'll be fun once a quarter to get together with John and just unpack what's going on.
It's everybody, by the way. Remax, Anywhere, Zillow, CoStar, they're all in there. So it's a pretty jam-packed conversation, so tune in.
Put it in your ears, kids.
John, welcome back to the podcast. We are excited to have you back because this is going to be a new series that we'll do every quarter. For those that are following all of the publicly traded companies, John is going to tell us his thoughts. I think you've been on before, but I guess let's give the listeners and viewers just a real quick background on you so they know who you are, who you work for, and what you do for a profession. And then we'll have a million questions that Keith and I want to go through today.
1 million.
Yeah. Awesome. Well, thanks for having me back. It's always a pleasure. So I'm John Campbell. I'm a research analyst here with Stephens Inc., managing director. I've been covering this broader industry for over a decade. We've kind of wrapped it around real estate services. Most equity research analysts are going to be in pockets of the industry, right? You might look at, like a software analyst or an insurance analyst covering broad, swaths of companies, but all pretty similar. This is a little bit of a unique approach by us. We kind of term it Moneyball, right? We're competing with the New York Yankees of the Goldman Sachs and Bank of America's of the world. And, we take a different approach where we look at the value chain. So I'm going to cover a Zillow. I'm going to also cover a title insurance company. So, there's been times where some of these prop tech, vertical SaaS plays will trade at higher revenue multiples than EPS multiples of some of the, more traditional players. So it's a unique approach, but I think it gives me really good insights, kind of taking that value chain approach, because if one of the dominoes falls at the front, Keith and I were talking earlier about, the HELOC opportunity with GSEs, like, all right, well, if that does happen, then the next question, if you're a portfolio manager for Fidelity, you're going to say, all right, I don't have time to get in the weeds of all these companies, but what happens to the broader industry when that first domino falls, right? So that's kind of our coverage universe. That's our approach.
So can I boil that just to be very clear for the simpleton people like me and a lot of the people listening? You help study all of these companies and basically help advise people on whether to buy or sell stocks of these companies. Is that, am I summarizing?
Yeah, that's right. That's right.
Okay.
The big difference is you look at the whole ecosystem versus a narrow slice,
that's exactly right. And so for us, the publicized version of us is going to be out, and you'll see in the Wall Street Journal, Stephens Inc. upgrades, Zillow or Redfin. Here's their new price target. But, behind the scenes, I'm working constantly with portfolio managers and analysts. So there's a buy side and a sell side. I'm on the sell side. So we're more the megaphone for the market. The buy side's actually the ones taking positions in these companies. And there's so many companies out there and so many moving parts in all these industries that you have to have someone helping boil the ocean, to some extent for you.
Yeah. So I always like to tell people who've never heard of you that you're the guy in the back of the room. This one of the smartest guys in the room that nobody actually sees very much because you're in the back taking millions of notes and listening to everything that people say. So, well, I know we have a lot of questions, and since this is going to be a series we'll do, because there's quarterly earnings reports, so everybody understands. Every quarter, publicly traded companies have to give an update on their financials, and we'll let you talk about that. We're going to cover 9 different companies. I think I'm my math right. 9 different companies today. Let's start with just a broader question of what's your read on the economy? how things are looking, what you're telling people, and like a 2-minute overview, what you're thinking 2024 is looking like.
And the exact date.
And that too.
Yes, that one.
Yeah.
Maybe leave
man, yeah, if I could get in the DeLorean, go back and get the almanac, and man, we would all make a lot of money. But man, I throw me in the camp of the higher for longer crew. Inflation's very sticky. And I think some of this, with shelter being such a big part of CPI, housing, home prices, rent prices matter a lot to CPI. And as soon as we lay off on rates, it's almost like, well, we're back to inflation, right? So I do feel like we're in a bit of a conundrum. The feds are doing everything they possibly can to try to stymie home prices to some extent. I just don't know what else we can do. The building of new single family units or affordable units that's going to take a long, long time. We basically just took a hiatus for several years, right? So we're just really underbuilt at this point. So on the inflation front, I think it's going to be sticky for a long time. And Keith, as we were talking about again, back to the GSEs and the HELOC opportunity, if you allow a lot more tapping into record levels of home equity, that's going to go back into the economy. We're not going to put that in 10-year, treasury yields,
Yeah.
Right. So it's a bit sticky there. The consumer is resilient. It's hella resilient. Even in the face of the 30-year rising throughout April, all the open order activity we're seeing, and I'll talk through some of this with the earnings recaps, and what some companies were talking about as far as open order activity, things are still very good, in the face of that. So
for the layperson, open order activity is that
a title insurer is probably the best proxy. It's a true oligopoly. So with what they report, the top 3 or 4, that's basically the market, right?
It's new deals going through it,
right? So whether
it's new home, residential resale, doesn't matter.
Commercial, refi, they touch commercial, resi, refi, purchase. That's right. And so when they open activity, that would be basically, you guys were closing a transaction, or you have 2 sides committed, right? And you start that title process. They don't get paid to 30 or 45 days, post that. But that open activity gives us at least a view into the next.
It's a good
That's right, exactly right.
For the next.
So things are good so far, right? Up modestly year over year in April. You heard Anywhere Real Estate, you heard Compass talk about some of the open listings, some of the open order activities, kind of singing the same tune. So that's very encouraging to us. I think we look at it from the MBA purchase apps too. So things are still good there. So to your question on the economy, I just feel like consumer remains really resilient. I think can remain resilient in a higher for longer. We track lots of stuff, including average credit card balances and debt outstanding. That doesn't look great.
It's big as it's ever been.
That doesn't look great. But, the big worry is that we hold higher for longer to try to kill inflation. We kill the consumer, right? And that's the delicate dance that they're having to play.
Yeah. And I know we need to get to the specifics before we start arm wrestling on the broader stuff. But if you kill the consumer, wouldn't that translate? And that's a very aggressive.
Guys. It's still early.
If the consumer slows down, John, we don't want to kill them. Wouldn't that cause at least a slowdown? And that should, in theory, that we don't have to tilt all the way into recession, but that should ease some of the inflationary pressure.
It should. Right, it should, and it's
theoretically,
it's at some point
it's a wild world. It is wild.
At some point, they have to view that kind of as collateral damage, right? To win the bigger victory over inflation, maybe is what has to happen. So we'll see.
And it's an election year, so everyone's got conflicting interests in all of this. Right. So.
Yeah.
All right, let's dive in. So we've got quite a few companies to cover. Let's start with Remax. We'll let you drive. Tell us your overall thoughts, changes, etc.
I've always liked Remax. I like the management team, like the recurring revenue angle to it. It's mostly franchise associated. It's all franchise. There's a little bit of an angle of variable revenue that's tied to them getting 5% of closed commission dollars from their agents. But for the large part, the biggest challenge with Remax has been domestic agent count, right? It's down, 14, 15% over the last 4 years. It has been on a perpetual slide, right? And they have announced multiple different initiatives to try to spruce that up. And they've made that the number one focus the last 2 or 3 years. And it's just really nothing's happening. right? One of the biggest questions I have with Remax that I just don't know. I imagine if we really dove deep enough in this, we could find this out. But what is the average age of a Remax agent, right? I would imagine it's very high, right? They were some of the most productive agents in the industry. But with each passing year, how much of attrition is due to retirement, right? People just leaving, right? So I think that one's been a bit challenging. Like, I think 1970s Dave Liniger Remax is today's Real Brokerage and EXP, right? It's just a different concept, and they're giving out more. Like, when you were a Remax at one point running 30% EBITDA margins, is that sustainable? I think is the question. And so I think, you've seen margins reset a lot. They tried to build technology. Right, they were one of the few out there, and everybody's gone through that. Yeah, right. That age-old debate of build versus buy. That's right. And they've outsourced basically everything to KV Core at this point, right? So they don't really have that angle from a comp payout standpoint. People are looking to go to Real Brokerage and EXP, right? So it's been challenging. So they've really had to lean on international growth. It's gotten to the point where total agent count is actually, they've guided on the low end of their guidance is for a decline year over year. It's the first time that would have ever happened, right? And the bad thing for them is the international agents are probably worth about a fourth of the revenue of domestic. And so it's been challenging, so like to think about revenue growth again for them, I think you've got to assume a pretty decent housing recovery. So I think you could be declining revenues for several more quarters from here. And this thing used to trade because again, it's mostly a franchise model. So as a public investor, we're going to look at it and we're going to comp it to Dunkin' Donuts and Papa John's and those guys. It's not going to be House, it's not going to be EXPI. But I think investors used to look at that. It used to trade as high as 14, 15 times EBITDA. Now it trades at 6 times, right? Which it trades like a brokerage, right? Despite having, good free cash flow and higher margins, right? So that one feels like it's kind of stuck. And also from a technical standpoint, it's very thin stock, right? So it's hard for the hedge funds to come in and out of. They can't, there's not enough liquidity there. And so it just feels like it's kind of stuck at this point.
What does that mean? Give a little bit. What do you mean by thin?
Yeah, so for
those of us that don't talk your terminology.
Right, so you're right, and I'm going to probably do that a lot, so stop me multiple times.
We'll stop you. Yeah.
We tend to speak different languages. When I go home and talk to my wife about some of this stuff, she's like, stop talking. Let's talk about something else. Let's talk about the weather. So a thin stock.
Just open wine,
That's right. So if you are a hedge fund, right, you're going to have to put, just for illustrative purposes, like you got to put $100 million to work, right? That's what's invested in your fund. You've got to put that in the market somewhere. And if you can't if you put all that into something like a Remax, to get out of it, it's going to take up 2 months. You can't sell it all in one day, right? There's only
because the appetite.
Well, a little bit of that, but also just liquidity, right? Like, so when you think about the shares outstanding, how many people actually own the stock, then you got to take out insider ownership and all that stuff. What actually gets floated, right? What gets traded on a daily basis, like to get out of it. And this is why sometimes
it takes.
That's
longer.
Right. So sometimes when you see high short interest, a lot of people short the stock. It can really you'll see a squeeze because people have to go cover all their shares no matter what the price is.
Okay.
Right.
All right. So, where are you guys at on the stock? Hold?
We're a hold.
And give the classifications so everybody understands how you approach.
Yeah. So you're going to hear. So our official ratings is overweight, equal weight, and underweight. And that's on a relative basis in a portfolio. So a lot of other firms are going to say just buy, hold, sell. There's different.
Yeah. Overweight meaning you should put more of your money.
You should be going
to perform.
That's right. And some of that is kind of relative to like the market, right? Like if you're having to be invested in, or if you're a generalist, you can invest anywhere. We're saying maybe be overweight this stock and maybe overweight this sector.
Yeah. Okay. So when you say overweight, that's a buy in normal parliamentary.
That's right.
And when you say underweight, that's a sell. Move out of that stock.
That's right. Else. And so Remax, we were a buy for a long, long time, dating back to 2015 for forever. That was one of the small cap darlings. Like it, again, high multiple, everything like
Yep.
Basically agent count drives that model, right? Like when I start my revenue model, I forecast, I'm going to start with number of agents and then its average revenue per agent, right? And they were growing at such a steady pace that it was just really consistent recurring revenues and high margins. And then that whole story just kind of changed over the last 3 years.
Got it. Okay. All right. Anywhere. We'll go to them next.
Yeah.
You call that the house is, I think, the
ticker,
the symbol. Is that, the ticker? Yeah. So, but anywhere, the brand. So for clarity, everybody understands this is going to be Coldwell Banker, Century 21, ERA, Corcoran, Sotheby's, Bedrooms and Gardens. Did I miss one?
Corcoran, Sotheby's. Yeah. I think you got all of them.
That's pretty much all of them. Okay. I may have missed one, but that's pretty much, everybody understands that's anywhere.
Right. So portfolio of different brands ranging from low end to high end. And they kind of started off from Sears, which with the idea of like the home was a center and you would cross sell everything. So you have mortgage title, you'd have Cartus, relocation, all that stuff. Where these guys went wrong was the LBO from Apollo. So and that was a leverage buyout.
LBO is
leverage buyout. So they acquire a bunch of debt to then go acquire the company and then throw all that debt on the company. And so when they did that, it was like within days of the crisis coming off. Right. And so when you look at leverage, a lot of lenders or credit investors are going to look at the amount of earnings divided by the debt. Right. And when you're going through the projections of acquiring that company, you're like, oh, things will be good for forever. Well, now maybe not in a cyclical company, right? And nobody really expected the housing crisis to happen to that extent. So their leverage turned to 11 or 12 times, which was super scary for any kind of cyclical based company. And so they've been clawing out of that for forever, right? The management team has done a phenomenal job of taking the strength of housing and really changing the debt profile. So took a lot of debt out, still very levered, but took a lot of debt out, termed a lot out. So extended a lot of the debt to give them a lot more breathing room. Right. So I think the management team has done a great job. Now they've cut.
Didn't they sell Cartus as well to help get?
They tried. They structured a deal with, I think, Serva. The deal ended up falling through, and this was around COVID, right? So that kind of got messy. I think Cartus had a pretty good rebound last year and a half. I think it's been under a little bit more pressure lately, but that's a good business, a good cross sell. But these guys have done everything they possibly can. I mean, the biggest issue though was forget inflation. Forget the downturn in housing. It's been Compass, and it's not even it's softening, right? When they were just throwing money at the market, and so you saw splits. This just triggered a splits war, right? Where all the splits for all the public brokerages were going up into the right. We're finally kind of subsided. So if you look at house this quarter anywhere, this was the first quarter since 1Q16 that splits did not increase year over year. So it's been, and I think I ran through this math with you maybe last time, but you could take EBITDA today or in 2023 and it's probably 5x higher if they run at the same splits from back in 2016 versus today. So it's been massively impactful, but these guys have done a good job. I think, if you look at total volumes for them, transaction volumes, it was up for the first time in 7 quarters, right? So that was a good outcome. It just feels like kind of this turning point. They also laid out a framework for 500, 600 million of EBITDA out in a normalized market. And I think anybody's definition of normalized, it's going to range from all over the place. But,
strange times, John. Normal isn't normal anymore.
Exactly. 5 to 5.5 million existing home sales, which seems 5.5 maybe seems a little rich, but I can buy 5.
Sure. We think that's realistic sometime between 2025 and 2026 for the 5 million number.
Quick glossary update, just because you've used it a few times. EBITDA is just earnings before interest, taxes, depreciation, and amortization. It's another way to look at the financial welfare. Or sometimes people will replace EBITDA and profit. They aren't the same, but it gives you a trend line for how the company.
That's exactly right. And EBITDA for us is the closest form of free cash. It's the easiest metric you can get to free cash.
It's also how companies are typically sold. It's multiple valued, but valued. All right. So underweight, overweight, hold. What are you?
We've been on hold on house for a long time. To me, it's I mainly see being long that as being long housing and being long eventual break in rates, and I think there's better ways to play it than that.
Okay. EXP.
EXP has been one we've been a big fan of. The whole story of breakthrough momentum, everything just screeching halt, Some of this is law of large numbers, where it's just hard to keep adding agents at that rate. But this was the second quarter of sequential decline in agents, which is from a story when these guys
one of your barometers.
That's right, 60%. Agent growth steadily from like 2019 to 2020 throughout most of 2021, and then the party just stopped. I think some of that is Real brokerage, and we can talk about Real in a little bit. Real is on a different planet right now. They are doing really phenomenal work right now. Reminds me actually a lot of EXPI 5 years ago. So, EXPI, the one thing, I think the biggest issue for them is they've just been warehousing agents, right? You pay, it's similar to NAR. You pay your annual dues up front, and you could sit there like a phantom agent for a year before they realize you're not even there, or you're not going to pay, right? So they went through this kind of, broad sweep of the agent base and cut out agents both this last 2 quarters. Despite that, a lot of hedge funds, we all can track their agent count from their website, right? So you kind of get a leg up, and as long as the average revenue per transaction or average transaction per agent, average revenue per transaction, all that, if that all kind of holds up, it looked like a big short, right? Like they were going to miss the quarter in a big way. They actually crushed the quarter. Crush expectation is because they were getting rid of agents who weren't doing anything, right? So the productivity is up a lot, average revenue per agent's up a lot. So I think that's been helpful for them, putting up pretty good fundamental results. But from a KPI, like key performance indicator, like a big driver for them was agent count, right? As long as agents were growing, the stock was going up. So it's had to kind of go through this metamorphosis stage of actually,
how much of that is just the natural evolution of a company going from small to medium to big? And then how much of that is pressure from competition, would you say? Like if you had to put a percentage on those two.
That's a good question.
Factors.
I think number one, far and away number one, is that has been dropping due to attrition, which the whole industry is seeing. I think that far and away is number one. Real brokerage is absolutely, they're not nipping at their heels. They're hitting them to some extent, right?
They're taking bites.
But they're at 16 out of 17,000 agents or so. EXPI is, multiple times higher than that, right? So like even a big lift for real brokerage quarter to quarter is not going to matter that much to EXPI. But I do think it's been an issue, just to be clear. The third thing is, I think to some extent, the law of large numbers, like you're just, as you get larger, to your point. But if you look at their agent NPS, and they track this like a religion, like net promoter score. So they track this like a religion, and it's held in very good despite all this industry turmoil, higher rates and competition. And they've also cut a lot of costs, right? So despite all that, the mood is still good. Right?
Good, solid, and look, I'm not being disparaging to any agent class, right? But solid, good, full-time, make a living, selling houses, real estate agents, and every company has some.
That's right.
To differing percentages, right? Those, that bedrock of quality agent is what's really driving things right now.
100%. This is not this industry is not 80-20. We're convinced of that now. It's probably 85-15, maybe 90-10, right? And this is the thing with the XPI. You have downline agents, right? So you get that the head vampire and all the other vampires like track with them, right? That's probably a terrible analogy, but you get the gist.
You've got kill consumers and vampires today, so congratulations.
Perfect analogy.
I have
John Campbell just dropped a cut. That's why.
I want two
questions.
Not
have that in my bingo card.
2 questions because we got a lot of companies to hit through still. Just real quick. Number one is, what is your take, and this will be relevant to all of these companies, on the settlements, and is that something you're factoring into the valuation of these companies? Potentially attrition of agents, potentially drop in revenue. Like, what is Wall Street's view on that?
I mean, this is topic du jour for the last several months for me.
Lots of old fashioned.
Just for time, just like kind of concise. Just what is it you're thinking? What's the general mood?
That this NAR settlement is going to go through, feels like, and it's going to be it'll be modestly impactful, but nothing transformational, right? I think the fear was that if you decouple if you ban cooperative commission, we got big challenges. So I think this is
and your view is that you don't see that as a big deal. You think consumers are still going to buy and sell houses with agents.
Yeah, exactly.
Yeah.
I think I think you've seen some of these stocks bounce back off of that view. Also, that 1Q earnings was just not as bad as a whole as people expected. Right. So you're seeing some life.
Follow-up question is, some of these companies haven't settled yet. So what is your view on that from a perspective of cash?
Yeah.
I've seen ranges anywhere from as low as 14% of their free cash to as high as 68% of free cash. How's Wall
I think
Street
most of the publics have settled. The home services settlement was surprising to us. EXPI is the one holdout,
Did Fathom settle? I don't think they did.
No, they did not.
Okay.
They took. I have to go back and double check, or maybe they took a legal reserve.
I don't think I've seen that. Maybe I missed it. But the point was, you're right. Most of them have settled, and it's not. You see that as just a blip, and we move on with the day, sort of thing.
I think that's it. Okay. And in EXPI, I think they're probably taking the page off the Tyson playbook. Remember the chicken cartel? Tyson was like one of the last ones. They never settled. And their idea was, and it was actually pretty clever. We'll see if this works, but it's like, all right, if everybody settles and this is about collusion, there's nobody left to collude with, right? So it's like kind of risky, but I can see the rationale.
Okay.
Yeah.
Let's go to Real, since you've been talking about them. They're we call them the new kid on the block from that perspective.
Grew revenues almost 90% year over year in the quarter. They almost touched 200 million of revenues. They were at 9 million in 1Q21, like barely even there, right? Like shouldn't have been even been public at that point. But not surprisingly, look at the stock performance, like blowing everybody out of the water. Right, the stock's up 3x this year. Year to date, it's up 4x over the last year or so. Fathom. Yeah.
Let me ask you the inverted question to the one we just asked on the. How much of that is the law of small numbers? And right? Like I get,
for sure.
Like how much? Yeah, how much of that is just the opposite of what EXP is experiencing? And I'm not being dismissive of that team.
That's
They're
a good question.
Team. They operate really well. They're doing smart things. But how much is this law?
A lot of it is that, and this is the beauties of micro cap or small cap investing, right? You want to get that company as they before they transform to something big, right? Yeah. And so these big growth rates, you're pretty accustomed to seeing that, but it's also that is typically what a breakthrough company looks like in the early stages, right? They're checking all those boxes for sure.
Makes
so
sense.
Just to follow up on that, and then we'll continue with it. So is this a lot, in your opinion, is a lot of it driven on the fact that people see it as that breakthrough company? So people, I'm going to paraphrase here, but people left Keller, went to EXP, now they're leaving EXP and going to Real. And then in 3 years, they'll be Keith James realist. I'm making this up, but like whatever's the new thing, and they make that move. Is that part of the way you look at things?
I think that's right. I mean,
it's just the migratory nature
I think a lot of agents, chase that shiny object, right? And this is pretty common. I'm seeing this a lot. And we'll talk about this in a little bit. I think this is some of the reason you're seeing rapid growth in memberships of Homes.com and Zillow's new listing service, right? That it's just kind of like, that's the newbies. It's the guys who want the blue check mark on Twitter, right? There's a market for that.
But from Wall Street's perspective, you guys are like, fine, because it just causes the stock price to go up. But then at some point, there's that law of big numbers effect that kind of plateaus out. And then you're like, okay, well, we rode that one up, and I'm not trying to make it sound bad, but like we rode that one up. And so we'll look for the next big thing to ride up. And that's your job basically.
That's literally why John gets paid. Right?
No, I get it. My comment is there's a lot of people who jump onto the bandwagon too late.
Yes.
And they expect that momentum to continue, and it's like, no, you got to be on the ground floor.
And really, like a lot of it is you're just moving people around tents in the circus.
That's right. And think about it like this. I mean, like my counterparts, the buy side, that one's actually investing in these entities. They are there to create returns. Like, they might not love the company. You don't have to love. You can love a stock and hate a company, right? And like this is like when you think about the meme stocks like GameStop and AMC. Hedge funds immediately saw all that action, and they started launching teams that will track Reddit, and they were like, they're there to make money. So
to make sure.
they're not afraid to jump from company to company, you know?
Yeah. No, I get it. I know it was a stupid question, but I just, for the audience, I wanted them to understand the look. It's like, we're going to ride these things as far as we can, and then we're out. All right. So on Reels, I'm assuming you're overweight, underweight.
I actually don't cover Reel. We track them very closely. They're part of this whole ecosystem. We don't officially cover them, so I don't have official rating. But it's one that reminds me a lot of.
It's a hot stock. So okay, all right. Fathom.
Yeah, so Fathom's been challenged. We were surprised to see. You can't ever tell when they say family for family reasons, but like when Josh stepped down at Fathom, a little surprising for us. But I think for Fathom, it's just they're so small, right? And when you think about the cash balance today, there is a bit of a going concern if they don't fix certain things, right? If they don't cut enough cost, if housing doesn't recover enough, like the trend line does not look good. It looks like a bankruptcy situation, right? Now they've just sold Dagley Insurance, which is their insurance operation. It was, just to give you a sense for how beaten down the stock is, that was 2% of their revenues that they sold off, and it was over half of their enterprise value. Half of the value of the company, right? According to how the market's valuing it, right? So that gives them the cash balance they need, or the cash injection they need to kind of make it to the other side. But one of the biggest issues for them is like some of these breakthrough kind of disruptive brokerages, they've been growing agent count rapidly, like 20-30% for several years. This last quarter, it slowed to 13%. But the biggest issue, the thing that really caught people's eye, is they talked up a little bit of attrition, but it was high-end producer attrition. Because if you look at their productivity metrics, so the average transaction per agent was down 20%. The market was not anywhere down that much, right?
So it's not losing agents, it's losing the wrong.
And this is part of this this is why, from a public company standpoint and from a cash flow and a balance sheet standpoint, like all these things have to come together and like live in the same world. And for them, they've had to figure out ways to drive better earnings to stay alive, right? So they've been massively raising price. Like last 2 or 3 years, they've raised price in multiple different areas. Your high-end producers have options out there. When you start hammering them with price, they'll go somewhere else, right? And I think they're filling that right now.
Okay. So underweight, overweight?
We've got a buy on it. This is one of those things where I was just talking about, you can hate a company, love a stock, love a company, hate a stock, right? Like this is one, and I'm not saying I hate the company, but like this is one where fully admit that the fundamentals are challenged right now, but we see a path forward and the stock is so beaten down that it's a buy.
Got it. Okay.
They'll make it to the other side. So you're just buying.
That's right.
Arbitrage,
That's
basically.
right.
Yeah.
All right. Let's wrap up with Compass before we dive into the blended portal brokerage and then the other.
Yeah,
ones.
Compass has done, I think, a hell of a job. Really changed the mentality and tightened the cost belt, right? Because those days of SoftBank, it was like, oh yeah, you want to print out everything color printed on one side? Go ahead, 300 pages, fine.
We like to refer to them as the United States.
So when that went away and then the market went away, it's just like, all right, well, we have to change. They actually clipped like 9 million of positive like operating free cash flow this past quarter in the seasonally weakest period. You're looking at, the last 2 quarters they've had, if you stack up the last 2 quarters relative to the year ago, last 2 quarters, they've had $143 million positive swing in cash flow from operations. That's a big move.
Mostly from cost cutting?
Almost all cost cutting.
Oh, huge. Yeah.
How do you, this is not directed specifically at Compass though, if you want to expand on it, please feel free. But when you look at that, you can cut too deep, right? You can cut to the bone where you're starting to impact your ability to function and operate. And how do you, like, obviously cut expenses grows profitability or EBITDA. That's great. Do you ever look at it at how, and is it too deep and too far, or is that too layered?
The answer to your question is always going to be, what is everybody else doing? Because if we all lay off, like everybody splits, stop, aggressively, expanding, everybody's product development goes down a little bit. I think they're kind of in line with the camp, right? Is what I would frame it.
Yeah. All right. Makes sense.
So you guys are which position on them?
We don't cover Compass either. That's one like real brokerage that I don't officially cover, but that to me, they're pushing the right buttons is what I would say. You think about this, like you don't ever let a nasty downturn like we've seen, you don't ever let it go to waste, right? Like you should get a lot leaner, and your operating leverage or your earnings power should be stronger as you get those volumes again. And I know this from my days working at FedEx before I joined Stephens a long time ago. I was on a team that was helping do massive rounds of layoffs in '08. Like identifying, it was so much fun as a young, worker in my first job, ruining people's lives. That was fantastic, but, not fun. But, looking at that 2 or 3 years after those cuts, when everything came back, revenues probably bounced back 30-40%, and fixed costs kind of went back 5%, right? Like, so everybody, you just learn how to live, leaner, right?
You just chomp down on your mouthpiece.
That's right.
Take the shots,
That's right. Yeah. So I think Compass is in that camp for sure right now. So that's why it's, like Compass is one of the few brokerages out there that's actually up, like the stock is up year to date,
Mm-hmm.
All right. We'll go to the three most controversial. We'll start with Redfin.
Yeah. So I just actually upgraded Redfin. I'm one of 19 analysts with a buy.
Really? Is that because Glenn was on the podcast?
Exactly. I actually,
John he watched it.
We're moving markets.
I actually led off with that. Yeah. Wall Street Journal picked it up and said, Real Estate Insiders podcast leads to Redfin upgrade. This was everything. Like for me, I am a contrarian for sure. That is my style. So this is not out of bounds for me. But it had everything you need. High short interest, stock off of like a, near an all-time low, right? Like it's half of what it IPO'd at. Like it's everything you need. Numbers have already reset a lot. To me, it just felt like anything half right is going to make the stock work, right?
Right?
I think you're starting to see that now. I think the fun, like they're like, if you look at their operational, like underneath the surface, the mortgage attach rates, the title attach rates, they're doing everything right. I think they grew revenues, 4 or 5% this quarter, and they grew gross profits 25%, right? Like, so they're like Compass, they've cut a ton of cost. They got to the point where, like to travel, you have to get CEO approval, right? If you're not in sales, right? Like they were really clamping down, right?
It sounds crazy, but when you're going through the dark times, you gotta put your helmet on.
That's
the belt.
That's how it works, man. We did the same thing. Only essential travel. Like you got to watch every penny on it. So do you think this is a question related to all three of these companies we're covering, who are trying to get attach rate on everything? Is there a concern that you guys are following? I'm not leading you with this. This is a genuine question. Is there a concern of how hard they're pushing to get attach rate before they're starting to cross into RESPA issues?
Yeah. I mean, you're seeing the CFPB start clamping down on some of these sham JVs.
No, that's what I'm asking. Is there starting to be headlines everywhere?
Yeah.
So
I think Redfin, because a lot of it is technology driven, and you're going to catch you in the Redfin funnel, and you're going to kind of stay in that digital funnel. They can kind of lead you there through software without making it too apparent, I feel like.
What is their attachment?
It's 28% in mortgage. Very good. It's title. It's over 60 something percent.
Zillow's doesn't even have that.
No. This is the beauty of like, so Zillow's gonna, you're gonna meet Zillow with a brand name, and they're gonna hand you off, and you're gonna work with Coldwell Banker, and then they want you to come back to Zillow for the mortgage. Like with Redfin, it's all one. It's all one value chain.
Well, but like, let me ask you this: a lot of their revenue is derived from leads they send out of their own network. I forget what percentage.
For Redfin? Yeah. I mean, they did, on a trailing 12-month basis, that's 40 million or so. It's been 150, 160 million in the last 3 years. It's a real business. And that for them, the margin on that is probably 90%. It is almost pure profit.
So a lot of people have been saying they're worried about cash runway with Redfin based upon their perceived burn rate. Is that a concern for you still, or you think that there's a light at the end of the tunnel?
So a big swing factor for me is when they announce they're going to sell their mortgage servicing rights. So that's going to be probably 35, 40 million right there. And then they just struck this deal with Apollo.
So they got a
bankroll. We ran the math on it. They're going to have, I think, enough cushion the next 12 months to not have to worry about breaking any debt covenants and being in any kind of real issue.
Just for people who don't know, so when you sell your mortgage servicing rights, basically what you're doing is rather than continue to have that cash flow coming in over time, you sell that cash flow to someone else for a lump sum of cash.
That's right. And it's essentially buying a bond, right? That's a coupon. You get a monthly coupon on it, basically.
Yeah. Last one on this, and then we'll move on to the other two. I'm assuming you also making an assumption here, but it'd be logical that the changes from the lawsuit are going to benefit them.
That was part of our. Is that why that was part of our take? Having the nation's far and away largest scaled brokerage website matters a lot. That aggregates demand. Forget what happens to MLS. That's pretty important. I do think we'll see to some extent a rise in do-it-yourself consumers who don't want to or don't utilize an agent at all. They've got Redfin Direct where you can actually put in the offer, right? They're your brokerage of record, and they might charge you 50 bips or something like that. So they've got all the tools necessary to aggregate demand and transact, right? And they have a scaled national network of home touring, agents to help you do home touring and stuff. So they can kind of handle a lot of this themselves.
Yeah. And just for all the viewers and listeners who think that Redfin's behind all the class action lawsuits, they're named and settled.
Yeah.
Yeah. Just want to get rid of the conspiracy theories right now.
Wait, is that one? I missed that one.
All right. So you're in the buy category with them. You're the only one apparently in the buy category with them. All right. Last two, we'll spend the rest of the time on this. We'll start with Zillow first, and then we'll go to their big rival.
For sure. So, let me throw in this last plug of Redfin. The Redfin Next program is basically them transferring over to a digital brokerage or a traditional brokerage, right? And they're going to have, this partner network, all these leads. A lot of those agents are already buying leads from them. They'll just get them for free now, right? As part of their.
And for those of you should go listen to our podcast with Glenn. It was great. He talks about that actually in detail on our pod. So
we'll link to that one in the show notes so that you can get to it.
All right, take us to Zillow.
Yeah, so Zillow CoStar is the combination of those two is probably 75% of my FaceTime talk time with investors. It is a very important, popular topic right now. I think Zillow's doing really well, just given the circumstances. I think the biggest issue for Zillow is, the buyer rep agreement. This is why they're rolling out their own special little short-term contract. There's also stuff with the FCC, the Federal Communications or Federal FCC. Go get the acronym later. So the FCC is right. So it's the one-to-one marketing law where you can't sell off a lead multiple times. They have to consent to be sold, essentially, which changes Premier Agent to an extent, right? So there's some changes there. I think there's ways for them to get around that for sure. They are in the process of rolling out to all these enhanced markets. An enhanced market for them is, the Open Door, iBuying partnership. It's real-time touring. It is flex. It is mortgage. It's all that stuff kind of put together in a package. And the results they're seeing out of their test markets, the early stage kind of cohort 1 markets has been phenomenal. They've doubled, tripled share in some of these markets. They're rolling out. They're going to be in 50, I think, by the end of the year. Or 40, maybe by the end of the year. But they're making a lot of progress there. If you look at Zillow's revenue relative to the national market, they've been taking share very rapidly the last couple quarters. So I think things are heading in the right direction for them right now. They've got a rentals business. They've announced kind of a new strategy where they're going to go a lot deeper into rentals, touching more multifamily. I think everything's going right with them right now. I think that the stock for investors tends to get grouped into like a rate trade, right? Like it's viewed as kind of like in to an extent, I get it, but like brokerage economics, like it's going to ride the rails of revenue trends for brokers. And so it kind of gets grouped into that world. And then people view it as, I think some people view it as a net loser with some of these industry changes coming. I think just the opposite, that we've got a buy on it. We've been a buy on Zillow for a while now. So I like where things are heading with Zillow.
John, can you answer one question that what I'm about to ask you for Keith and I? We ask ourselves this over, and this is to our friends at Zillow who are listening. Please don't take offense to it. We're just asking the question. 18 years and 2 quarters of profitability.
John and I thought about this.
Yeah, so if you take out stock-based comp, stock-based comp has a value. And getting this level of traffic and this embeddedness with consumers off a product you're not really creating, you're just replicating. to have the throne that to sit on the throne they sit on right now is you have to spend money, right? And
sure.
So now would be the time.
But at some point, you should make money.
This is true.
No,
this is true.
Me.
This is true.
Yeah, I got another Zillow question. Is it coincidence, in your opinion, that they came out with their showing document? I don't know, 3 days before their earnings report.
No.
No, right? They needed an answer to what in the hell are you
That's
going
been
to
a big
do?
debate that Keith's been pounding. And I'm with Keith. I'm like, it makes complete sense. Public perception.
Now, so I threw this out to you guys last time when I said that one day Zillow could potentially be a brokerage. And you guys laughed at it. I'm telling you right now. If the industry, like touring is so damn important for their transactions, right? Like, because you think at the top of the funnel, this is the bridge that gets you down closer to transaction. The touring is super important for them. If agents don't play the game with them and sign their short-term contract and it hurts the touring,
they will.
They might just.
But the agents will
tour it themselves.
But they will.
I agree with you. If they don't. That premonition might play out.
John, we've had this discussion. You and I are on the same page. I think that there are side effects that if the industry isn't paying very close attention to, it actually could become the full-blown brokerage that people always say that they are.
It could be Redfin, right? I think the way Redfin's model set up could be the blueprint.
Mm-hmm. You heard it first from Mr. John Campbell. So Keith's like, nah. To be clear, I'm also with Keith. I don't think people are going to do that. They're going to follow whatever Zillow tells them to do.
I think it's plausible? Of course. Right? If they can't get the industry to adhere to a standard of care with the leads that come through their website, then maybe. But otherwise, they're getting comparable to broker revenue, maybe even higher, without the capex of opening a brokerage. Yeah. Why? Why would you do it?
I get it. You're not wrong. I'm just there's just interesting comments there. So all right, let's finish up on CoStar because lots of announcements over the past few weeks with it.
Yeah.
So
I like what CoStar's up to for sure. The biggest issue with them, and
speaking of throwing money,
exactly, world's largest marketing campaign in the history of real estate. But so the biggest issue for them right now with investors is that they're clearly taking their eye off the ball in the core business, the core CRE business, in favor of Homes.com or the Resi build out. The core.
When you say CRE business is what?
That's basically their core data suite, which is like if you're a JLL or CBRE, it's a utility. You have to have it. Then they have LoopNet. They have Apartments.com, which is like multifamily.
Commercial real estate.
That's right.
Commercial real estate and rental real estate.
That's right. Marketplaces, services, data, all that stuff. Right. And so Resi is obviously a new opportunity they're building out, throwing a exorbitant amount of money at Homes.com, but the bookings they were phenomenal in 1Q. And when I say bookings, that is basically a forward indicator for revenues over the next couple quarters, right? Because you get somebody to sign up for a subscription service, you're not going to get all that revenue in the quarter. It'll come out over time. So we look at that as kind of like an annualized number. And so their bookings were phenomenal. What we were talking about earlier is how much of that is early stage growth, right? How much of that is the shiny, flashy object? And if things slow down, then you're in trouble, right? We also track this very closely. We have a website tracking where we know what the memberships are today. And on a week to week ad basis, it is doing this straight down, right? Like it's slowing down for sure. I think some of this is also, and you guys know this from going to these industry conferences, a lot of these agents will go have 4 gin and tonics and go to the vendor booth and go pull out their credit card and start buying stuff, right? You see it. I've been there. I've been there.
Stop it.
Been there.
You get out. You stop it right now. That's never happened.
I've been there. And those listening right now are like, oh, I did do that. I did that last time. I say that because when they're doing big industry events, that creates lumpiness in the ads, right? And they haven't done anything the last couple months. They'll be doing Inman, they do NAR, right? They're gonna and they're like platinum sponsor for some of these Inman conferences. Like this is where when they talk about spending $1 billion, right, in marketing, it's not just TV. It's Inman, right? Inman's like thank you, right? Right. So that's some of it too. But all I have to say, the Homes.com early stage build out, the foundation has been very good. It's ahead of expectations. A lot of investors, I would venture to guess, almost all big CoStar holders do not ascribe value to Homes.com. They see it. Right. They don't believe it. They see what the opportunity is.
No. Yeah, they're betting on the core business.
That's right. So and you just nailed it, Keith. And so like this is part of the challenge right now with CoStar is you've got
how do you
exactly. So you got half of your business. The other business you've always valued feels like it's weakening a little bit in favor of something you don't ascribe any value to at all, right? But that's the next leg of moving the stock.
I don't understand what that take. How is that weakening? Like they're still operating their core business. You mean you could have poured all this money?
And the big thing is every single salesperson at CoStar is selling homes.com, right? I think they said that, I can't remember the stats, 80 or 90% of people actually sold a homes.com membership across the whole sales force. And they're also changed the comp structure. And as we all know with sales guys, you've got,
you change the comp, they'll move that.
You tell me what to sell, gives me the paid the most, and I'll go sell it, right? If CoStar was selling hot dogs, right, and you got paid more, they'd do that, right?
I'll just tell you, having spent some time with Andy and his team, they are on fire and very much like very, very focused on winning the space.
For sure.
Yeah. Like, I mean, I got to spend quite a bit of one-on-one time with him and he is brilliant. He is, I would say, ferocious. Like when he goes after what he wants, and he's got a lot of money to throw around to do it. Right. So I think
and in my relentless pursuit to try to understand Wall Street's lack of care for profitability, they were profitable last quarter.
Oh yeah, these guys have really high margins, very profitable business. So that definitely checks that box. No, but Andy Florence, if I could go back and write a book over my decade plus of experience of like the big characters that you end up seeing out here, Andy Florence probably has a chapter himself. He is really smart guy.
A smart and aggressive with a track record. I mean, so far
he backs it up.
He hasn't missed.
And the last thing I'll call out, James, before we wrap up, Matterport deal for them, I think could be one of the most transformational deals they've ever done. When you think about the MLS opportunity, so the idea here is Rightmove REA Group. There's not MLS. They are the MLS. This is why their margins are 50 to 70% in those markets. Really high recurring revenues, like really good models. The idea here is as long as they're MLS, you don't need to pay a CoStar or Zillow to aggregate listings. If the MLS system is breaking down just naturally, okay, that's great for both of those guys. But I think one of the things that could be very interesting here is when you run a Matterport scan, right, to do a virtual tour, it picks up everything in that house, including the square footage, bedrooms and baths, floor layouts. Yeah, right. You add the drone technology around, you can tell everything around the house. It's going to give you everything the MLS gives you, plus probably 2x the data fields.
So it's interesting because that also applies with appraisals and Fannie and Freddie down the road. Because we were just having this conversation with an appraisal company. Also, if you look at, go ahead.
Sorry, James. Wasn't that price kind of big though? I mean, if it doesn't turn into right, I get they have some crossover with commercial and apartments, and maybe if you blend it across their entire offering, it makes it. But I was surprised at that number. No, but like the percent premium they paid, it looks kind of crazy, but like it's a fraction where it was a year ago, and even minuscule where it was when I IPO'd. But
I was going to state that one other thing to think about, so it's something I've been working on, and then we got to wrap up here, is if you think about where we're moving from an augmented reality perspective, and I've been spending a lot of time studying this, they just actually leapfrogged Zillow in that regard because of that tech. It's different than what Zillow's using to get the same experience. And I actually have a video in this keynote that I'm doing that's what's the future look like in 10 years when Apple Vision is actually something you can actually wear. And there's an interesting play there with that. So if you're thinking long term, Keith, my answer would be it's a very cheap buy. If you're thinking that sounded all wrong. My point is, I think if you look at where they're going to go along with it, I think it was a smart move on their part.
Basically, it's digital twins, right? It's the spatial data. That's a huge opportunity. And to your point, it's like writing down in pen and paper what a home looks like and then getting pictures like that. That's a transformational shift. Totally the pictures to the spatial data is a whole different thing. Cause like you think about the use cases aside from AVMs and the data, right? You can go work with remodeling companies. Hey, I can go visualize if I knocked out that wall on that house and created a larger space and then brought this in, blah, blah, blah. Or if I added a pool in the back, there's lots of use cases that you can do when you create that digital twin. Sure. Yeah.
But there's other technology that does the same thing.
That's right. These guys are the pioneer, though. I mean, they were one of the first ones, and like
Yeah, pioneers usually get killed first, and then that's how
What
pioneering
is it
works.
with you guys and killing civilians today? Like, what?
Everybody's getting killed, right? Inflation is killing everybody.
This is
Anyone can get it
depressing.
today.
So-
Yeah.
John, thanks for being here. That was awesome to get the breakdown from Wall Street's perspective. We'll look forward to having you do this every quarter, and Keith and I will certainly have more research and information to debate you on. We appreciate it, and we'll look forward to having you back.
Yeah, it's always a great pleasure, and enjoy the time today, guys.
Awesome.
All right, be
Thanks,
well.
buddy.
Thanks, guys.
It's our job to say out loud what everybody's only thinking to themselves. It's your job to subscribe to this podcast so you never miss an episode.